really, this is 80 years in the making. It's certainly 43 years in the making from the 1980 lows. But really what we've done is from the Great Depression, coming out of that and coming out of World War II, we've had these cycles where each successive cycle pretty much has built in has created these imbalances and excesses, oftentimes inflation and overheating, that then require a Fed to lean against the winds and tighten down the hatches and bring the economy in so you can kind of work out those excesses and then be clear to rebuild another cycle. We've done that cycle to cycle all through that 80 years, and each successive cycle, again, pretty much, we've had bigger excesses that required more aggressive tightening and more aggressive leaning against the winds. And then coming out of that, you were in a deeper hole and came again. So what we've done is kind of built up these excesses cycle to cycle where it takes more to crank them down. So then we got 2008-9, which was the biggest financial crisis in our history. And we printed an awful lot of money to get out of that. We continued doing that and following the zero interest rate policy for more than a decade. And that's created even bigger excesses. So the biggest excesses of our history occurred in 2008-9. And now we're here at this point in time staring at far more debt than then, far more debt than we thought. That was off the rails. Far more leverage now, far more derivatives now. So you have 330 trillion in global debt. You have quadrillions in notional value of derivatives.
Yes.
I call debt leverage on the system, leverage on the economy, and derivatives leverage on the markets, whether they be fixed income markets or equity markets, what have you. So leverage, we know from business school, is great on the way up. It leverages your returns on the way up if you do it right, but it's really damaging to you on the way down. It could be deadly on the way down because you've got all that debt and leverage that's working against you, and it can put a lot of people out of business, into bankruptcy, et cetera, a lot of companies. So that's where we sit, is this, we're at excesses we've never been at before, by far, beyond anything we've ever had. And you combine that with, because of the last cycle and all the zero interest rate policy, all the printing, you've got a Federal Reserve led by Jerome Powell that believes, and has stated many times, that was a mistake. He got, the Fed got criticized for it, et cetera. And he's taken that to heart and said, we promise you, we're not going back to the zero interest rate policy. We're not here to backstop the markets. We're here to kind of keep the economy moving along. And when we see excesses leaning against them, particularly inflation. So they are of a mindset, and it's collective mindset throughout the Fed, that you want to be very careful not to go back to the policies of the last decade. And, we don't want long runs where you print too much money and you create all these other problems. So that means when things start coming apart because of all this leverage in the system, the Federal Reserve is going to be very slow to act. They're going to be very cautious about, they'll put money in, but they're not going to put in the kind of money that probably needs to be put in, because they're still looking at the last war. They're fighting the last war, looking at the last cycle and saying, we learned our lesson. We're not doing that again. And then let's say they start putting some money in, maybe $1 trillion in, and they find, given that the whole globe is imploding, that's not nearly enough, and things keep imploding. So they say, I hate to do this, but we got to do a couple more trillion. They do that. The point is, it's going to take them a long time because of their mindset to get to a right-sized policy. As a result, you're going to have all that time, because of the leverage, things will happen. The unwind will happen fast because of the leverage. During all that time that you're getting that unwind, they're having, they're walking into the policy. They're not getting anywhere near what needs to be done. And again, I'm using the Fed as the example, but this is really true across the board. All the central banks learned the wrong lesson of the last cycle. It's a correct lesson, but unfortunately, the only tool they have to meet a global bust head on and do something about it in a timely fashion is money. So if you are cautious about using your money, meaning the monetary expansion, you're going to just allow something to get a lot bigger than it needed to get.
Well, David, let me take maybe a little different perspective just to elicit your thought. And this may be what you feel could be a U.S. advantage, but maybe a decade or more down the road. You're correct, the $37 trillion deficit backed by quote unquote nothing. We also have corporate debt and personal debt. When you factor in the U.S. only, I believe those rough numbers are about 170 trillion. But what other country could say this? Not just our natural resources, including commodities like oil, and the fact that we're self-sufficient there. But you look at the value of our companies, the value of our resources, it probably is a multiple of that. And I don't know if any other country could say that. Where am I missing the point, or where might I be correct, but that may take 10 years to play out?
Yeah, the problem is that when the cycle unwinds, all that stuff becomes moot. It's nice to have that there, but it doesn't do anything. You can't pull the resources out of the ground to meet the unwind fast enough. It's just like somebody in a home that has a bankruptcy. They may say, well, I've got things tied up that, fixed assets tied up that if I could liquidate them, I could pay my mortgage, or I could, hold off the bankruptcy. Unfortunately, a bank says, no, sorry, we're collecting now, and you don't have any way to stop that. So yes, we may have assets in the ground. We may have advantages in some ways, but this bust is all about an economic cycle that is highly leveraged and going to unwind very fast. I have to say, some of these other things that people are throwing out in terms of stablecoin and some things that they can do, I just don't think they're going to be nearly enough to offset what is coming at you in terms of both magnitude and speed.
Some people may be thinking is China, Japan, and others may not buy as much U.S. treasuries moving forward. Would stablecoins be a way, I'm not going to quite say to keep the Ponzi going, but a little bit, built upon the rails of Ethereum? Are they basically going to be buying trillions of dollars of U.S. treasuries? That will be interesting how it plays out. Like you said, it's worthy to note in our brain, but still may not be enough to really move the needle relative to the things that you're talking about. Back to your deflationary forces, when you say that to me, I'm thinking of AI. When technology can eliminate jobs faster than the economy can create them, doesn't that almost guarantee demand destruction that you've been kind of predicting? Does that play into your thesis?
Yeah, it may a little bit, but I don't think this cycle so much. I think AI is still in its infancy, and so I don't think it's going to impact. It's not really the deflationary force I worry about for this cycle. I think that force is strictly macro. It's basically all that leverage on the system and policy errors, along with, I put this in there too, because I don't think people pay much attention to it anymore. There's a lot more fragility in the system because of the pandemic. So we're going into a down cycle here because of the crazy stuff that happened since 2020. At least in this country, small businesses are a lot more vulnerable. We got a whole different job market than we had before. Certainly in the last 4 years, we had an invasion in this country in terms of the open borders. There are a lot of things there that are below the surface that I think will kind of bubble up. But the biggest things are, a monetary mistake, a Fed policy mistake, a central bank policy mistake around the world, combined with this massive leverage. And I just think that's where you get deflation. We're at 2% inflation now, probably. The numbers that we use, the numbers the Fed uses, are probably biased upward because they don't account for the slide in housing that we're seeing. They don't account for a few things. So I'd say we're somewhere between 2 and 2.5% inflation, and we're about to enter a recession. Normally, we enter recessions because we have high inflation, maybe double-digit inflation. So we're down closer to zero inflation than we normally are going into a recession. And so that's why I'm pretty sure we're going to get into deflation in this, particularly if we're going to have the biggest economic downturn and financial crisis of the last 80 years. Yeah, that's not where I come from. Basically, I think this is, as I said before, 80 years in the making. I view it as basically inevitability. They don't have a choice. That, like I said, the policymakers don't want to print money. That is the change here. They don't, Powell is sincere when he says, I don't want to do that. The central bankers that are on the committee really are all pretty much have bought into that idea that was a mistake. So I don't believe this is some kind of conspiracy against the little guy. It's basically the only tool they have to deal with something. At this point, if you ask the central bankers or you ask the government policymakers about a global bust and describe what I meant by a global bust, they'd say that's a very remote possibility. They are not expecting this. That's the point, is they'll fight. They'll tell you very sincerely that they don't plan to go back to ZIRP policy. They don't plan to go back to printing money, pushing out a lot of QE. And they're very sincere about that. That's nice to say until you're facing it, and you're looking at banks failing across the globe, big banks. And you're sitting there and you go, oh my God, what do we do? They can't sit back and say, well, in the long run, if we do this, it's inflationary and we know we shouldn't do this. They're going to be scrambling to do whatever they can, just like 2020. Look at 2020. I'm saying 2020 times 4 in terms of money, 20 trillion. So it isn't is no kind of planned thing. It's not them saying, hey, we can inflate our way out of this, and we don't have to worry about this debt because we'll just inflate our way out, even though it hurts the little guy. It's none of that. This is coming as an inevitability as a result of 80 years of bad policy, at least a lot of bad policy. And so I don't really see it that way. What I do agree with is that ultimately, with probably a couple of year lag, you're going to jumpstart an inflation cycle that will exceed the early 80s, meaning you could see 25% inflation in this country early next decade. And it'll be disastrous for most people, but certainly the little guy. And if we don't obviously go from 0 to 25 in a couple of years, it'll go, coming out of negative inflation, you'll be in low single digits the first year, higher single digits second year, double digits the third year. I'm just guessing, and then higher double digits and ultimately above 20% within 5 or 6 years. I don't think most people have any idea. You and I lived through the early 80s. Mm-hmm. I don't think most people have any idea how really hard to deal with that is.